Global expertise from San Fran to China. We are core consultants, not your average miner. DSC and Darby now confined to the house. And so now we bring you core from the couch.
Hi, I'm Lara Smith from Core Consultants. I'm sitting here with Trent Mell from First Cobalt. How are you doing, Trent?
Very well. Good to see you again, Lara.
Good to see you. And congratulations on the feasibility study put out yesterday.
Thank you. This is actually the first interview I've done since putting that out about 24 hours ago. So nice to catch up with you.
Oh, that is great. So I got you in good time. But you had a webinar conference, no? Or was that not?
We did, yeah. Put the results out in the morning. We had a webinar, over 200 people participating from around the world. So it was a great attendance.
No, that's excellent. You've actually done an interesting thing. When I looked at it, I was very interested to see your results from 25,000 tons, and you're deciding to toll treat, and you've actually negotiated a very high payable. Maybe we should explain what a payable is to the audience, and then we can speak about that, because well done on that. Very, very high.
Yeah. Well, so what we did in this is we hired Benchmark Minerals to do a bit of a market study for us. And so the economics of treating cobalt, I mean, first we got to look at the market. It's largely DRC. That's 2/3 of the cobalt's coming out of the DRC. In the copper belt they're producing copper cathode that goes to market, and then hydroxide largely finds its way to China. And so the market we're seeking to enter into, the cobalt sulfate market for electric vehicles or batteries generally, and that's China. That's 79% of the refining capacities in China. The rest Japan and Finland. And so what happens is you produce the hydroxide, and then you're paid a percentage of the cobalt content, and it ranges from about 59 to maybe 80%, and it moves in tandem with the price of cobalt. And so we made an assumption, long-term assumption on cobalt of $25 a pound, and then we bumped up the payability, which moves in an equal fashion up to 70%. And then we applied our engineering and our network on an asset level basis to show what the refinery could do if it was on par with the Chinese. Now, but you're right, Lara, ultimately these asset level economics, we're going to have to overlay another commercial construct. It is going to be a toll. And so we're showing, $39 million of cash flow in year one. That's going to be shared between us and Glencore, because the arrangement we have with them is that they are going to toll treat. We'll earn a margin. We'll push for upside exposure. And so these asset level economics just helps us set the backdrop for how we're going to proceed with our partner.
Yeah. Okay. And why I was very surprised at the 70% payables is, as you quite correctly said, it moves in tandem with the cobalt price. And what we saw in the last sort of 2 years is we had the payables as high as 90% on hydroxide, which was amazing. And then that came down to 50% when the cobalt prices dipped. So what you're actually saying is that you're a long-term cobalt bull, and that you've actually managed to negotiate this and put this outside. So maybe just speak a little bit about where you see the cobalt market, because that part says everything. And let's go from there.
Sure. Yeah. And I just to clarify, I think what we have here is really, it's more of an economic model. So there's a set of assumptions. So if you look at Benchmark, whom we used for this study, they've got a long-term cobalt price of, I think, about $26.80 or so a little under $27 a pound. Long-term payability assumption of 70. So we scaled it back to 25. It's low compared to today, right? Fast markets, we're under 17 today, and I think we even dipped under 16 for a bit. I'm not quite sure where it sits today. So, but we're coming off a multi-year low, and their projections, in fact, 7 of the next 9 years is even higher than their long-term price. So I think we're in line with their projections. Scale back, we're in line with Macquarie, RBC, Barclays, and a few other long-term price assessments. It's a tough market, as you know. It's a small market, so it's a little bit volatile. But ultimately, this is merely it's a straw man. It's a straw man with some assumptions that Glencore was happy that we use. But the commercial, I guess we got a lot of catalysts now. Now that we've got the economic analysis and the technical work done, we now need to do some optimizing, because I think the economics here get better. And we need to understand precisely what that commercial contract is going to look like with Glencore. And to be 100% transparent, it's not going to be a payability factor. It's going to be a toll rate. So the framework agreement we have with Glencore, and this is the way we get out of the gate from junior to cash flow without diluting our shareholders, is they'll provide all of the feed. and in exchange for 100% of the capital, they get all of the offtake product. So it limits our upside, but it also is a great eloquent way for us to get to cash flow on a debt basis. And within 4 to 5 years, we have that paid off. And so the market still has to wait and see what those economics are going to look like.
Right. Okay. And Glencore, interestingly, that they took Mutanda offline.
Yeah, they did. They took Mutanda off, and they bought the balance they didn't own of Katanga. And so they've got 2 big commercial operations, and that's where the feed's going to come from. And I've told investors time and time again, as much as we may have issues with the DRC, and rightly so, with respect to geopolitical matters and issues of provenance and child labor and so forth, those issues don't exist with Glencore. I mean, this is a big commercial operation, not unlike anything you would see elsewhere around the world. And in sourcing our material, they're a great partner, because there's never any doubt if it's coming from one single commercial operation, and that our refinery is treating only their material from an end user perspective. You get pretty comfortable that we're not going to jeopardize your brand by blending in material from a questionable source.
Yeah, and actually, I think that's not very well understood by the market unless you're actually in the cobalt game, is that you can actually get specific brands. It's not like coal, where everything gets mixed together. You can actually ask for Tenke material, or Mutanda material, or a very specific material which does not get blended. The issue comes more on the processing and sort of more downstream, where things start getting mixed up, and that's where there's earned a bad name and a bad reputation for child labor and everything else. But even if you've got DRC material, or you mix up with Glencore or something, that doesn't mean that they don't have a clean supply chain.
That's right. That's been essential for us. Eventually we'd like to have North American feedstock for our refinery, but this continent we're not there yet. We're still a few years away. Idaho looks extremely promising, as does the recycling market a few years out. So until we have that, the next best thing we can do is to take material and reroute it, stuff that's currently going to China, bring it to North America. And there's a lot of advantages. And for that reason, we've got the interest of governments on both sides of our border, Canada, US, because it addresses critical minerals. It addresses, Chinese trade concerns, trade war issues. And now with COVID, there's a real focus by our sector, the auto sector, on trying to shorten the supply chain so that when borders shut down, you're not closing your plant because of some other jurisdictions' woes.
Yeah. So because of cobalt, I'm wondering, would you start to focus on America, or is it really just a few years away? Are we just not being in America?
Yeah, we've kind of, I guess we're staking our reputation for the next year or two on the chemical side of the business. It's an odd match, even though they're complementary. A chemicals business is very different from the mining side of the business. And so this is our nearest term opportunity to graduate in terms of where we sit in the cap tables, the league tables. And it's easy insofar as you don't have the risk of permitting, because it's a permitted facility. You don't have the long lead capital blowouts that you see in mining projects where you're building roads and power lines. It's already there. And thirdly, you don't have that risk of a mine plan where until you pull it out of the ground, you don't quite know how it's going to work in your facility. We've got 2 big established operations. We've got known specifications. And so we're going to be taking a known existing product and running it through a hydrometallurgical facility. So the risk profile is low. The execution timeline is relatively short. We can have production in 6 months if we move on a small scale, and another year for the big scale. And the confidence in the flow sheet, that we still got to do more work, but I think that's what investors should be watching. Can we meet the specifications of a German or North American auto company? And that's going to take our focus for the next 3 months as well.
Okay, so what are the next steps? You've mentioned processing and flow sheet. What else?
Yeah, so in our feasibility study, the economics were great out of the gate. We've got after-tax IRR of 53%. We've got an after-tax NPV of 139 million Canadian, 1.8 year payback. And yet there are so many opportunities to improve this. We limited ourselves to a 93% recovery. We'll get over 95, and that was a function of a bench scale single batch lab test. So recoveries alone give the economics a good boost on the NPV side. We also have a very expensive sodium treatment solution. We're using a sodium reagent, and so we either need to switch out that reagent or find newer, maybe somewhat novel technologies, because it's a $9 million capex on 56, and it's roughly 70 cents of a 272 operating cost. And so there's a bunch of optimizing that we're going to do. We also ran our economic model on 11 years, even though our stage 1 dry stack tailings has 17 years. So we can probably stretch that out. So we'll optimize. Number 2, I would say we got to sit down with Glencore and work out the commercial terms, as we've already discussed. Related to that, though, is there's an underlying assumption they provide 100% of the capital. We've got a dozen people under NDA that would be willing to co-fund with Glencore, and that just reduces our reliance on a single partner, which I think is good for our interests. We've got talks going on with the government for a loan guarantee, which would lower our cost of capital, and then we've got all the work with the end users. Now, that's Glencore is leading that, but we're very much in the flow. We've got specs from half a dozen companies, and it's a question, as you know, it's a chemical specialties business, and the residual deleterious elements in a cobalt sulfate, the tolerance levels for each manufacturer is going to be slightly different. And we can meet on all the specs we have. We meet most of them of any one spec, but we haven't tried to target a particular spec of sort of company X, and that's going to be the next stage as well. So lots of catalysts. I want to get most of these things done over the next 60 to 90 days so that I can come to the market with a go-forward plan. And part of that go-forward plan is going to be, while you aim for the outcome outlined in this DFS, there is going to be a startup scenario, a small scale, a pilot plant, a demonstration plant using existing permits and facilities. And I haven't described that in great detail yet because there are a lot of contingencies we're still working on right now.
Right. Okay. Thank you very much for that clarification.
Thank you.
Maybe just getting back to North America, we've seen a lot of research and a lot of policies on America backing critical metals and wanting to back their domestic supply chain. What do you feel needs to happen in America for them to compete and for it to be a viable jurisdiction and for them to actually secure their supply chain?
Yeah, so there's a couple of interesting things have happened. Of course, late 2017, cobalt, among others, was added to the list of critical minerals by executive order. And that created a little bit of an impetus to turn their attention to what we're going to do. But, the decree alone doesn't matter if you're not going to put sort of meat on the bone. And so I've had a lot of engagements in DC with all kinds of different agencies, whether they be regulatory, State Department, White House advisors, around how do you move that forward. One step which we saw in rare earths was a further decree. It's basically a defense procurement proclamation by the president on rare earths, which has led to government money going into rare earths. So you've got, I think 3 or 4 days ago, relating to Mountain Pass and the U.S. government trying to build a rare earths processing facility. And so that's step one in rare earths. As you know, it's medical devices, it's aerospace, it's military, it's also EVs, so the batteries, or the magnets rather. So if you take that to its logical conclusion, then cobalt may find its way there. And so my advice or my feedback to the U.S. policymakers is there's 2 ways you can help us. One is obviously money is always hard to come by in this market. Number 2 is going to be regulatory regime. America's a fabulous place to run a mine and a darn hard place to permit a mine. And so let's focus on the permitting and get ourselves de-risked, because America's they've got a competitive advantage that I think is underappreciated, and that's the Idaho Cobalt Belt. You've got primary cobalt deposits. They're high grade. You've got the issue of federal lands on a lot of these deposits, and you've got the added issue of arsenic that you need to contemplate in your flow sheet. But if we can focus on that, and they're starting to, maybe you'll see production, but I would say it's probably 2 or 3 years away. There's basically ourselves and Jervois out of Australia that are the most active in that area.
Okay, thank you. Maybe just explain, because not all of us know what federal lands actually means if we're investors from outside of North America.
Yes, no, fair point. And so U.S. land, if you have it private land, as we do, the permitting process is shorter because you're typically dealing with the state. But under, I guess, U.S. sort of colonial days, as they were expanding westward, jurisdiction for lands was assumed by either the BLM, the Bureau of Land Management, or the U.S. Forest Service. And so you're under one or the other. And this current administration has made some big strides to lighten the regulatory burden. And we've seen, look at, the Pebble deposit up in Alaska is controversial, but a classic where you're going on for decades to try to permit. You don't know if it's going to take a year or 5 years or never when you're on federal land. And Forest Service, I think we have some work to do. BLM's getting better, but the big focus is when you got to go back to DC for a permit in Idaho, that distance creates its own bureaucratic, process that tends to grind things to a halt. So there's a big push to try to push the authority down to the state level, and there's still some work to be done there.
Okay, all right, thank you very much for that. Anything else you want to add before we wrap it up?
Yeah, I think this is an exciting time. COVID aside, We saw it in the UK, right? Auto sales were way down in March. Not surprisingly, EV sales were up. And so we're going to take a pause here, but the EV revolution, as I call it, it's not going away. And I think the timing of our stories at a 12, 18 months out aligns really well with what we're seeing in the market. So it's a fun space, and it's a space where mining has a real difference, right? Blue skies and a cleaner environment. And it's, so I just invite your viewers to follow the what we call the electric metals. It's going to be a fun few years ahead.
Yeah, and as one of our other speakers said, during COVID, one good thing is that we saw a world without pollution. And this is what it is for us.
And I showed my kids some of the pictures, New Delhi and and Shanghai and LA, and I'm proud of that. I'm proud of that what we're doing here in the electrification space can realize that you don't need a pandemic to get blue skies. We just got to change our ways, and it's in front of us. It will happen. It's just a question of how quickly we get there.
Yeah. Trent, thank you so much. Best of luck with the next steps.
And I appreciate your time. Thank you.
Take care.